Hello everyone and welcome back to Bullion 79. My name is Goldie and today we're diving into a proactive question. Are US Treasury bonds the safest financial instruments, or could they be the biggest scam in human history? But before we start, please like and share this video and don't forget to press the bell button so you don't miss any of our newest videos. Let's get into it. US Treasury bonds are often hailed as one of the safest investments, thanks to a robust bond market and the United States' reputation as the leading global economy. However, as we stand at the beginning of 2024, it's time to critically examine this perception against historical returns and the broader economic environment. So let's look at the historical performance of US bonds. Let's look back a decade. Let's start with an example. Investors buying US bonds then enjoyed a yield at around 2.6, 2.7, 0.8 annually. This seems reasonable with a 30% return over 10 years when you factor in reinvested interest. But here's the catch. The return didn't keep up with the dollar's devaluation, aka inflation. During this period, inflation and living costs rose by more than 30%, diminishing the real value of these returns. To understand this better, let's explore what a treasury bond is and how it works. So, a treasury bond is essentially a loan to the government with the promise of periodic interest payments and a return of a principal upon maturity. But if the inflation rate outpaces the bond's yield, the investor loses purchasing power. And we can see this best when we compare US bonds to other investment options that reveals a stark contrast. For instance, real estate in the US appreciated by over 57%, and gold's value increased by more than 47% in the same time frame. This trend indicates that nearly any investment outside the traditional monetary and banking system of government bonds would have yielded more profit. Let's have a deeper look into why this is the case and what factors contribute to higher returns of assets like real estate and gold. So investors holding long-term US bonds, particularly those bought during the pandemic low interest rate environment, have suffered. Some saw losses of up to half their investments. This situation impacted not only individual investors, but also banks with capital surpluses held in bonds. Banks, however, can swap these underperforming bonds for cash with the Federal Reserve. You don't have that option. That's a privilege which is not extended to the ordinary taxpayer like you. Let's break down why this is significant and how it reflects a disparity between institutional and individual investors. A crucial aspect of US bonds is the perpetual debt rollover. Instead of true repayment, new bonds are issued to cover the old debt and interest. This cycle requires the US to run a budget surplus, reduce spending, and increase taxes. But you just know as well as I do that all these options are not politically viable. The growing debt pile possesses a challenge in attracting buyers for new bonds. There simply isn't enough buyers to fund the government via bonds. Do you think it's a coincidence that whenever there's a stock or crypto rally, within the same week when there is a bond auction, the media talks about a recession, market crash, etc.? The only option left at this point is monetizing the debt, which is already happening via the failed banks from last year of 2023 who are forced to buy government bonds with printed money, printed bailout money provided by the Fed that created it out of thin air. But hey, since it's a loan, it's not calculated in the money supply, right? So if you look at the M2 money supply, it didn't increase much, even decreased slightly, because it's a loan, right? It doesn't matter if it's a loan or not, because it has the same effect on the economy. The government is flushed with cash provided by the Fed, which printed it. And that additional money is then spent in the general economy, which increases the money supply and increases demand in the economy, which increases inflation. It's just printed money and monetizing the debt with extra steps and using the banks and their bailouts as a middleman. So the perceived safety of US bonds is an illusion, especially in the long term. For those seeking investment avenues, history points to real estate and gold in times like this. Real estate offers both income and appreciation, while gold, not yielding interest, can be sold at market value. It maintains its purchasing power over centuries. However, it's crucial to remember that past performance does not guarantee future results, and thus thorough research is essential before investing. So I really hope you enjoyed this video. There's going to be a part 2 because there's so much to talk about bonds and so many details that I want to get into. So to not miss this opportunity, to not miss the newest video, please Don't forget to like and share this video and click the bell button. And let me know in the comments what you think. Thank you very much. See you next time.